Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, December 2nd. Jobs report Friday, but even more importantly, we got our December macro scouting report coming out this afternoon. So I'm very excited to be presenting that to 42 macro subscribers. Completing the deck, working on the finishing touches this morning. I do happen to believe it is probably the best piece of research, single piece of research I published, and I published some damn good research throughout my 14-year career. So definitely come check that out. I think $100 is a reasonable investment to make to equip yourself with all the information that we think you need to risk manage the next 2 to 3 quarters of macro cycles, particularly the liquidity cycle, because I think a lot of investors are getting that wrong. But onto the liquidity cycle, I think we got an important update this morning in terms of our economic release spotlight from the November jobs report. So I said it and I'll say it again, and I've been saying this for months now, but the U.S. economy is booming from a coincident to lagging indicator perspective. And that boom implies that all the leading indicators that everyone continues to point to are slowing and declining from booming levels, which implies it's going to take a while for us to get to recession unless the Fed materially accelerates at the pace of tightening, which may very well be on the horizon depending on how November CPI behaves on Tuesday the 13th. But anyway, getting into the jobs report, we saw a significant we saw a slight deceleration in private payrolls growth. If you look at it on a 3-month annualized basis, minus 10 basis points to 2.1%. That's the lowest print we've seen since January 2021. No change in the 3-month annualized rate of change in average weekly hours. Basically flat. But so the big move, the big surprise in this morning's print was a sharp increase in average weekly earnings. We saw a 130 basis point acceleration into 6.2% on a 3-month annualized basis. That's the fastest print we've seen since November of 2021. And then when you productize those things, so private payrolls, average weekly hours, average weekly earnings, average hourly earnings, you wind up with private sector labor income. And that number accelerated 120 basis points to 8.5% on a 3-month annualized basis, not year over year. 3-month annualized, so the last 3 months, the private sector, the income consumers are getting from the labor market is growing at 8.9% on a nominal basis. That number, or 8.5%, sorry, that number is nearly double the pre-COVID trend, and obviously well north of anything that is even remotely consistent with the Fed's inflation mandate. A couple other things I want to highlight in the jobs report this morning before we turn it over to my Lomo dashboard. We also saw a 10 basis point decline in the employment to population ratio that was mirrored by a 10 basis point decline in the labor force participation rate, which itself was broad-based. We saw a decline in the prime working age labor force participation rate. We saw a decline in the elderly labor force participation rate, 55-plus-year-olds. And then we saw a decline in the female labor force participation rate. So riddle me this. We have labor supply dwindling. And as a function of labor supply dwindling, we also have wages skyrocketing. How do we get out of a core services inflation problem, particularly core services ex rent of shelter, which we've been talking about behind our paywall for months now as the #1 driver of the Fed's reaction function at this point? How do we get core services inflation, which, by the way, Powell called out in the Brookings Institute meeting a couple of days ago, and no one really picked that up, but he actually is the 3rd or 4th time this year Powell said something that we said explicitly in our research. So I got to believe somebody's got this guy a subscription to 42 macro. But anyway, core services inflation, ex rent of shelter, is the #1 thing we think is driving the Fed's reaction function right now. And it's going to be very hard for that statistic to break down with people leaving the labor force and wages skyrocketing. I mean, have you been out to eat lately? Have you gotten on an airplane lately? Have you gone to a hotel? Have you tried to consume a service in the United States of America lately? There's no one to be found. Lines are long. It's impossible to get what you need. And guess what? If you provide services, you could charge higher prices for them for the first time in a really long period of time. Companies want to make money. Companies don't need this. The Federal Reserve is not telling, you can't tell companies what to do. I want to make money. I run a company. You probably run a company. You want to make money. Just because the Federal Reserve is hiking interest rates doesn't mean you got to suddenly stop trying to make money. And that's the making money part of this is what inflation is. That's the inflation that we're all seeing on our screens that we ultimately think is likely to cause problems for risk assets. So on a medium-term duration with respect to the liquidity cycle. So sorry for that rant, but anyway, 150 slide presentation this morning. We're going to get through it in an hour and 15 minutes. That's my promise to our subscribers this morning. But definitely come check us out, because again, I think there's a lot of information, particularly if you're a professional investor. I don't know how the hell if you're a professional investor, shame on you if you can't make the expenditure of $100 to get that kind of quality information. I've sold presentations like that for tens of thousands of dollars before. And so at $100, you're going to get the best deal you're probably going to find all across global Wall Street. That is a promise. Anyway, getting to my Longbow dashboard, global macro, starting with global macro tab, US dollar. We talked about that being bearish from a short and medium term perspective. It's at the bottom of its range. It's coming off the bottom of its range now, or getting towards the bottom of its range now. It's actually coming off this morning. Gold, that's bullish from both the short and medium term perspective, overbought. So definitely getting an overbought signal in gold here is to be a good spot to be putting on gold shorts, if you will, if you believe our net liquidity driven view, which again, we believe is being corroborated by today's jobs report, the first leading indicator we get for what November inflation data might look like, by the way. They're starting not the first, second, really. We got a couple others already. 10-year getting towards the lower boundary of the range there. Short-term price momentum is bearish, medium-term neutral there. What's the lower boundary there on the range for the 10-year of 345? That seems like a mirage, but we'll see. Again, we talked about this in our research as well. If we do see a net liquidity driven decline, I do believe it's likely to be bearish for bonds as well, because I don't think we're close enough to a recession for investors to really start to reach for duration. But I could be wrong on that. I'm less convicted on bonds as I am on risk assets at this particular juncture, given that we are now officially in grid regime deflation. VIX, that's bearish in both the short and medium term perspective, getting towards the low boundary range. As I said, I don't think anything with we broke down below 20, but again, I think this might also be a mirage as well. So I wouldn't be chasing VIX much lower than here. Again, so folks want a Santa Claus rally. Santa Claus rally may happen. Darius Dale does not tell global financial markets what to do. I'm just saying it was based on our interpretation of the data that we're accurately forecasting, have been. It's very unlikely that we see one. And well, by the way, seasonality tends not to work in bear markets, by the way. We've done a lot of research on that behind our paywall as well. So definitely go check that out. We'll update those seasonality charts for our subscribers today in that presentation as well. Russell 2000, NASDAQ Russell, neutral from a short-term price momentum perspective, both nearing the upper boundary of their trading ranges here. Bitcoin and Ethereum have backed off their upper boundary of the ranges, as did the Shanghai Composite. And then crude oil, that's been bearish. One of the kind of the saving graces for asset markets in terms of this Goldilocks move we've seen throughout the month of October and November to date has been one of those things. So if we start to see any sort of pickup in crude oil that really starts to kind of trend, that's going to be an issue in terms of adding incremental goods inflation back into the system at a time where clearly services inflation is running amok, to borrow overuse a phrase from times past. And anyway, concluding with my free daily alpha tab, where we sort 300 ETFs, all representing individual factor exposures by the odds tab to give a sense of what's most overbought, most oversold. Getting a lot of we talked about our leadoff morning note this morning, and a lot of kind of our crowding model, which is our sort of flows-based, options-based flows model that tries to help generate tactical trading signals, generating a lot of tactical trading signals on the short side of counter dollar trades. So things like the British pound, et cetera, will be one of those things. And now it's being corroborated by my Longbow dashboard in terms of the quant math behind that. So I'm starting to get to starting to feel like the dollar is getting long in the tooth. This correction, this pullback we've seen in the dollar, again, doesn't have to happen today. I think we have a major catalyst coming down the pike in terms of the 13th and the 14th. But again, maybe it's getting started today. We'll see. Again, I don't tell markets what to do. I just position for what I think is going to happen, and then we'll go from there. And then lastly, kind of what's most oversold here. So let's see. A lot of inverse ETFs, as we talked about yesterday, inverse bonds, inverse stocks. What else? Trying to see if I can get something new for my friends here. Anything particularly exciting? No, my friends over at Simplified PFIX. So interest rate volatility has gone no bid recently, alongside kind of the bid in duration. Are we done with interest rate volatility? I'm not so sure after this jobs report. So this might be a good spot for those of you who don't think we're done with interest rate volatility, and also believe what we believe to be true about the pending path of net liquidity. This would be a good spot to be kind of accumulating some of that. So anyway, wrapping up, again, catch you back here this afternoon in terms of our December 22 macro scouting report. We appreciate everyone who does subscribe and who does appreciate that research. And for those of you who don't, If $100 is too much to help you manage risk, then you shouldn't be operating in financial markets. And I genuinely mean that. Cheers.